kick off, the numbers have jumped up even in the last minute or so. So we've got quite a few of you online. So to everyone, welcome to our second webinar with Tom Schubert from Drummond Capital. For those of you who joined the first one, the feedback was exceptionally good. Hence why we're running another one of these webinars, which we want to try and do a couple of them during the year just to keep you up to date. As you know, you get plenty of email correspondence from us with portfolio changes, but to have Tom available for him to talk to you directly, to go through the presentation he's put together, we know that adds a lot of value to us working with Drummond on behalf of your portfolio. So with that, Tom, I'll hand it over to you. So yeah, please sit back and enjoy the next 50 minutes or so of the presentation from Tom. Thanks very much.
Thanks, Steve. I'm just going to bring up the presentation, so give me 2 seconds while I share the screen. While we get this going. Okay. Can you see that, Steve?
I can, yeah. Absolutely.
Excellent. Yeah, I'm just going to move this out of the way. Oh, well, good afternoon, everybody, and thanks, Steve, Brendan, and the team at Halcyon for having me along again. I did mention the Q&A box if anyone's just joined, just at the bottom of your screen if you want to type questions as you go. That'd be great. Otherwise, we'll come back to them at the end. And just a little bit of an agenda, the things we'd like to cover today. I mean, Steve mentioned there's regular updates in relation to changes in the portfolio. So I guess we will do a little bit of a recap, first and foremost, just on market performance recently and sort of how our thinking's evolved over the last 6 months. You know, how that's then translated into performance and the current positioning of the portfolios. We'll then look at, you know, bigger picture economic outlook, an update on the rollout of the vaccine and the implications for the economy and markets. Then we'll revisit sort of some of the bigger pictures, our long-term scenarios and how our thinking's evolving there. And that'll include a bit of a deeper dive into inflation, something that we're spending quite a bit of time working through at the moment. And finally, we'll just conclude on sort of where valuations sit in a shorter term, sort of 2021 outlook. So firstly, just a recap on the previous 6 months. It's been a very strong period for global markets. The left-hand chart essentially is just growth assets, so such as equities, and you can see really over the 6 month period, the dark blue line is global equities. You know, it's up close to 20% over the last 6 months. The Aussie market, the yellow line is sort of approaching 15, and defensive assets on this side are unsurprisingly sort of flat to slightly down. So it's been a really good period for risk on, essentially. So just a bit of a recap. At our last update in October, you know, we highlighted that economic growth was rebounding and markets would sort of start to look through the valley towards the recovery. And we also highlighted the large gap between COVID winners, such as the big global tech companies like Microsoft and Amazon. And the market classifies these as growth companies. And then the difference between those and the COVID losers, which are things like the travel stocks, banks, energy companies, the really economically sensitive areas of the market. And the market classifies these as value companies. And you can see on this chart here, growth has been a clear winner through the post-GFC period. And that trend really accelerated through COVID. And actually the difference between the performance of these two different types of companies or sectors, if you will, has been at its most extreme, even more extended than what we saw post the sort of dot-com bubble and subsequent wreck. And so look, back in the September and throughout the back half of last year, given how extreme this move was, and also that we were starting to expect higher economic growth, which could benefit the economically sensitive areas, we'd progressively started to sort of rebalance portfolios away from some of those high-flying tech winners and COVID winners towards areas of the market that are sort of more set to recover as the economy recovers. And so, you know, on the 10th of November, and we'll go through some of these changes specifically, we really started to pick that process up. So the first vaccine was announced on the 10th. The second vaccine was announced on the 26th, and at each occasion we made changes to the portfolio to sort of take advantage of this trend. And you can see post the tech wreck, there was really value outperformed growth right up until the GFC. And then post GFC, it was growth outperforming value for a long period of time. So we think these trends can persist. And if you have a look at the top here, we think that we might have potentially reached a turning point as well. So we don't need to rush these things, but we certainly need to pay homage to these longer term trends in markets. And this just highlights a little bit more of how far potentially there is still to go with this. This is a chart just showing the COVID winners, which we talked about a second ago, versus the losers. And you can see even just over a 12-month period, the winners are still up sort of over 50%, whilst the losers, if you will, are still down 13%. It's started to close the gap a little bit since the vaccines were announced, but there's still a long way to go. And so part of, a lot of these companies are listed in other parts of the world. So the US is very technology heavy. All the big listed tech names, the Facebooks, the Microsofts, the Amazons, etc., all listed in the US. And so the US market and indeed the global index is dominated by those sectors. And so we've been looking towards Europe and Asia to get more exposure towards sort of banks and financials or resources and commodities. If we look at that, Australia is quite well placed as well, and you'll note the changes to increase exposure to Australian equities as well. We might just take a look at some specific examples of this. Magellan's probably a manager which you'd be quite familiar with. They've been a really successful manager for global equity investors in Australia for a long, long period of time. And, we commend them for what they've done, but they had started to get a little bit big. And got very, very concentrated in those technology names. And so last year, sort of in August, we made a switch from Magellan to Affinity, which is another global manager, a little bit more diversified, less focused and less concentrated in the technology sector. And you can actually see the effects of this. It didn't do much for the first couple of months, but really post that vaccine announcement in November, you can see the broad market and Affinity, the manager, we own up sort of 11%, and Magellan's really flat basically since the change. So these incremental changes in the portfolio are adding some value. The change we made on the Pfizer announcement was adding another global equity manager called Pan Tribal. They have a lot less exposure to the US, more to Asia, more to Europe, and more to financials. And indeed, you can see since that change was made, the fund is up 14.5% versus the broader market of just under 6%. Again, just highlighting the beginning of these new trends in markets. Similarly, in Australian equities, we have focused on managers with more exposure to those cyclical parts of the market. So this is OZCAP. They have a larger exposure to real estate, banks and consumer stocks, really, again, sensitive to the reopening trade, if you will. And we added this fund on the Moderna vaccine on the 26th of November. And again, it's up over 10% versus the broader market just under 3%. So we like to think about the long run and sort of break it down into a series of short runs, and which then have signposts to guide us. And in this case, it was the positive announcement of vaccines that help us sort of start to adapt the portfolio and move down this path. So there's a couple of examples of those changes.
And I think, Tom, if I could just jump in there, I think
sure.
For clients, that really does illustrate the advantage of this service and the ability to, have someone like Drummond monitoring the markets for us continually and being able to bring those new funds to our attention, then ultimately putting them into the portfolios compared to the more static annual review type service that was previously what you're in, where, if you're in a Magellan, well, you wouldn't have basically had a touch for 12 months, but you can see the value that by being active and aware of what the markets are doing, you can see, from those examples, the value that can add. So I think that's a really powerful message for you to see on the screen.
It's a good point, Steve. It allows us to make changes in a kind of really considered and staggered fashion as our thesis and conviction builds in the view. We wrote extensively about all of these issues, the election, the return to value, the outlook for growth late last year, but we don't have to try and predict whether we're going to get a vaccine or predict what is going to happen in the US election. We can actually, we can think about it and we can have a wish list of things we would like to do, but we can actually wait until we've got the hard evidence from the announcement before making a decision. And it substantially reduces the chance of making mistakes. And it's a much better way to manage risk. So You'll see that's how we manage.
Yeah, and it's also important to point out too that from that time where, you know, the team at Drummond identify an opportunity, it's effectively in the portfolio, what, Tom, within probably, you know, 48 hours, something like that, isn't it? So the turnaround time is...
It's very quick, yeah. So best ideas implemented very, very quickly. Yeah, exactly. Not to say we haven't done, you know, we might have been tracking in some cases those managers we've met for well over a year and we like them, but the timing wasn't right to include them in the portfolio. So, so we've always got sort of a bench of good ideas and then wait for the markets to indicate when we should make the changes. So just how are we currently positioned? So, look, at the moment we're reasonably constructive on growth, and I'll go through that in a little bit more detail throughout the presentation. But you can see, just to explain again, but we consider neutral as 50% growth, 50% defensive for the 50 portfolio, or 70% growth, 30% defensive for the 70 portfolio. So when you see +5, we're at 55 or 75 in this case. We're overweight what we consider our neutral allocation to growth, because we can, you know, we're positive on markets and have been for a while. So, and that's reflected really with having a little bit more international equities and Australian equities, which I spoke about, which we've been quite positive on recently. And we're still slightly underweight real estate. We can talk a little bit more about the REIT sector, but I am back in the Melbourne CBD again this week after another week out last week, but it's still very quiet in here. And the commercial real estate agents we talk to tell us that the vacancy is 14% in the CBD, going to 20% this year. And there's still some challenges for large parts of the commercial real estate market, which we think need to be worked through. So we still have a little bit of caution there. We think there's more upside in other parts of the economy from reopening. And we're also quite underweight, or, you know, lower exposure to things such as particular government bonds. As the world recovers, bond yields rise, which means bond prices are falling, and you can lose money along the way. And they've got a really low starting yield, sort of just over 1%. So we don't think you're compensated for that risk at the moment. It's a good thing that bonds are selling off. It's an indication that the bond market also believes in the economic recovery. But what we're trying to do in this part of the portfolio is reduce the sensitivity to those increases. And so we are underweight there. Similarly, on the corporate debt side, we are slightly under. We had quite a large overweight for a big portion of last year following the sell-off in March. It was an area we found quite a lot of value, and we did have a lot of corporate debt, and those markets have just rallied a lot. The spread you earn over cash has come down a lot, and again, we think there's less compensation for being there. So we've reduced some of that exposure, and that's really just what's funded the overweight position in growth assets such as equities. So how's this translated into performance? This is up until the end of December, so it gives you a calendar year read. Just to explain, the peer index is basically a composite of all the large institutional funds that have a comparable risk profile to each of the portfolios. So you can see we spoke about how strongly markets have performed over the last 6 months. And you can see really if you look at the high growth and growth portfolios, you can see double-digit returns, sort of 11.5% and almost 14% for the high growth, which is over 2.5% ahead of the peers. Encouragingly, for the year, really, really strong outperformance versus those peer indexes, which is a combination of getting the mix of managers right, having those technology managers for a large portion of the year, as well as de-risking the portfolio through the worst of March and then re-adding exposure as the year went on. So a combination of efforts. And pleased to say that 2021 has commenced strongly. The audited figures for January will be out this week, and I'm sure the guys will give you an update on that. And February month to date is very strong as well. So may the good times continue.
And I think it's worth pointing out, especially if we just go back to the performance, Tom, for those that were in it through the sell down, over the last year, balance has returned 7.6, but we had a period there from late February to late March where the portfolio fell probably 15%, something like that. So notwithstanding that sharp fall, we still went out and actually generated a positive return of 7.6, which is...
Yeah, there was a minus 35% market in March.
Yeah.
And actually, if the benefit of active asset allocation, so not losing as much as the market and having some cash to deploy, but secondly, just staying the course.
Yeah, and I think
believing
that's the
in
message,
the
isn't it?
diversified portfolio, because in the end you got a 7.5% return for a year, and I think most people look at that for 2020 would be reasonably happy given what took place.
Yeah, which just goes to show, as you said, the benefit of staying the course, and how many, how many retail clients at the end of March, given what the news flow was and what portfolios had happened the previous month, would have been inclined to sell out and sit in cash. And
that's right. It's very hard to come back from that.
Exactly.
When you lock in the losses.
That's right.
So now I'll just give a quick update on growth. So this is our proprietary global growth barometer. It captures about 150 different data points, and it gives us a real-time read on economic growth. And just to recap, you can see sort of the depth of the decline. This is the US on the top and Australia on the bottom. Was more than twice what you saw in the GFC, but equally the rebound was incredibly strong, much stronger than coming out of the GFC as the world reopened, and also the amount of stimulus that was provided. In the US, you can see the growth rate sort of moderating over the course of the last 6 months, and we expect this actually to rebound again as the vaccine is rolled out and as the next round of stimulus from the Biden administration is rolled out as well. Interestingly, Australia had a similarly large decline in growth here, but we didn't quite experience the same recovery, and that's due to us here in Melbourne primarily with the really extended lockdown. It is starting to pick up now, but again, the sort of haphazard border policy and lockdowns probably are holding us back. So we will really welcome a vaccine this year and hopefully see a proper reacceleration in our growth. And so here, a bit of an update on the vaccine. We think this is a really important, it's a really important consideration, I guess, for the outlook. There's been a lot of noise, I think, around both the virus and then the vaccine. And I think we need to focus on the big picture here. This sort of busy chart is really just trying to say when they expect that 50% of populations will be vaccinated around the world, based on different considerations, and beyond 50%. Once you get to that sort of 50-60% mark, that's when you start reaching herd immunity. So the virus will start to deplete out of the population, and so based on this, developed markets, so the Western world, by sometime around mid-year, will be getting close to that sort of 50% level. The US is actually on track to get there earlier. They could well have herd immunity by then. In fact, we've seen estimates that given how much they've already had in caseload through the community, plus the rollout now is at 2 million a day, it could be as early as April or May. And so this is really significant. So generally, by the third quarter this year, most of the developed world is going to be close enough to herd immunity that essentially politicians will not have to worry about locking the economy down. The healthcare system will no longer be constrained. So whatever vaccine it is, and there's data coming out already, Israel's a long way ahead of everybody in terms of the rollout of the vaccine. And the evidence, is showing the Pfizer vaccine, we thought we needed 2 doses. There's evidence that one actually can be quite effective. There's also evidence now they're saying that they won't have to keep it in deep freeze. And so all of these factors go to improve the rollout of the vaccine. So that's happening. Production is ramping up. The logistical effort to deploy it is also ramping up. And later this year, we're staring down the path of not having to worry about COVID. And that is a big positive for growth and markets. So now let's take a look at the big picture. We outlined our 3 scenarios of the world in last year's strategic gas allocation review, and we're commencing the review now. So it's a good time to sort of revisit these. Our central case is what we defined as return to normal. Now, this is a repeat of the post-GFC environment, which is low economic growth, low interest rates, and low inflation. It's really good for markets generally, as we know. They've performed really strongly since the GFC. Then we have our sort of everyone is Japan scenario, and this is really deflation and low growth, and that environment becomes entrenched. And look, when we did the review last year in May, this was still a meaningful probability given the depth of the global recession at the time. But we think now it's become a much lower probability of occurring than certainly what it was this time last year. And then we have our higher inflation scenario. So this is coordination of stimulus by central banks and governments generating much higher levels of inflation than what we've become accustomed to. And we think that there is indeed, look, there's growing evidence to support a much higher probability of this occurring. Recent actions, so the Democratic blue sweep of the US election, so the Democrats now have the House, the Senate and the presidency, enabling them to spend very freely. And so we're seeing huge stimulus packages announced. 1.9 trillion is the current bill that's going through. This is big spending, and that's really supportive for growth, but it also creates inflation. And the other factor here is the US Federal Reserve, and they're taking the lead. They're talking about average inflation targeting, and all that really means is they're sort of saying they'll let it run hot for a while to sort of catch up for the lower inflation that we've experienced over the last few years. So the combination of those two policy changes, we think, sets the scene for a period of higher inflation than what we're used to. So let's take a bit of a deeper dive into that. So first chart here is money supply. So this is in combination really because you've got unanchored spending by governments around the world. COVID recession has enabled both sides of the floor, so left-leaning and right-leaning politicians, to essentially forget about austerity and just spend money to win votes, to reflate economies, to decarbonise economies, whatever excuses they tend to prefer to lean on for their constituents. But all of them are now spending a lot. We're seeing huge budget deficits all around the world, and that is combining with really extraordinary monetary stimulus. So interest rates are at zero, and in addition to that, central banks are printing money and buying bonds, so quantitative easing. And so you can see here the rate of growth in the money supply in the US is approaching 25% a year, and that is a rate we have not seen since World War II. So this is significant, and higher money supply often translates into higher inflation. So that's one factor we're considering. The second one is there's a lot less spare capacity in the economy. If you look, this is US unemployment rate. You can see post the GFC, it took 10 years really to recover the jobs that were lost. Whereas because of the support that's been provided, the equivalent of JobKeepers and JobKeeper payments essentially around the world, we saw a really high headline unemployment rate, but a really quick snapback. And this gap is already, we're back at 2014 levels of employment, and this is before the next round of stimulus, and it's before the vaccines are rolled out. So we expect this gap to close quite quickly as the economy reopens. The other thing to consider, so most consumers have been stuck at home. Many have received cash handouts, and many of those people still have their jobs, and so they've saved that money. If we look in Australia, there's more versus the pre-COVID. Australian consumer has saved $200 billion and sits in cash in the bank. And so we're not traveling as much, we're spending more on goods, but as we actually reopen and get back out into the economy and do so with confidence, because we'll be hopefully living in a COVID-free world, there's a lot of firepower at the consumer level. There's lots of firepower being deployed by central banks and governments. And we think that combination creates really, really strong economic growth this year. Almost the strongest rate that we've seen for nearly 30 years. So second half of this year, we could be seeing annualized growth rates of sort of 5 or 6%, which if you think about that, versus a zero interest rate, there's a bit of a disconnect. So this is likely to, we think, create higher prices as well. And so what does the market say on inflation? So break-even yield is really just the market pricing for inflation. And you can see in the US, it's rallied, they both got down to zero as we're in the depths of the crisis last year. And expectations for future inflation have now increased back up to 2.3 in the US and approaching 2 in Australia, which is just, it's normal, really. But I guess what we're wondering is, how much further does this go as the economies reopen? So we will be keeping a really close eye on this. There's other slight indications that there's higher inflation coming. Commodity prices have been really strong. So price of iron ore, oil's back to $60 a barrel. Copper, nickel, etc. We're seeing higher demand and higher prices. We've seen things like Bitcoin, which some argue is an inflation hedge. We think it's a bit more speculative than that, but certainly, it's been very strong this year. It's just something we're looking at very closely. And certainly we've been starting to position portfolios for this scenario. So we spoke earlier about value companies or cyclical companies, resources, banks, These businesses do much better than the tech businesses under an inflation scenario. And so we've started to rotate the portfolio. So we're positioning for this to sort of play out. And we also have a small position in gold, which under a much higher inflation scenario can also do well. And so finally, we'll just take a look at equity valuation. So I think we showed this chart last time, but I'll explain it again to make sense. So the pink dot, if you will, is the current price to earnings ratio in this chart on the left, or price to book ratio in the chart on the right. The blue line is the average, and the yellow lines are sort of the highest and the lowest that they've been in history. And really, you can see the US is actually looking a little bit expensive in absolute terms. So it's approaching 24 times PE, which is near top end of the range, and it's actually at a new record price to book valuation of 4 times. And other markets around the world, UK looks reasonably good, well valued. Japan is cheap. Emerging markets, none of them are outright cheap, but they're certainly not as expensive as the US. And so part of what we've been doing in portfolios is to progressively rotate away from some of that concentrated COVID winner, technology winner. The US has really, for 10 years, beaten the rest of the world in terms of equity returns, and for good reason. They've had better companies. But we can start to see an environment where the higher economic growth actually benefits the more cyclical, exporting nations like Europe and emerging markets. And there's better value in those markets. And so we're trying to capture, what the next stage of the cycle looks like, not what's been working for the last 10 years, I guess. And so a bit of a shorter term outlook. And we think this is a really key thing to watch in addition to the inflation. So I will try and explain this chart as well. So the blue line at the top is what we call the earnings yield for equities. So that's the yield you get for owning a company. And this is the US, and you can see it's sort of close to 5%. It's a little bit lower today. And then the yellow line is the US 10-year bond, or interest rate, if you will. So you can see that now that's about 1.3 today. And this blue line at the bottom is the gap between the two. And so it sits around 4%. And at 4%, you can see there's long periods where that's been quite stable, and that's quite a good additional return you're earning for being invested in equities over bonds. What we're interested in is when this declines a lot, is when we've started to see equity market correction. So last time we went through, if we go back to sort of 2016, 17, was when the Federal Reserve in the US started to increase interest rates again. So they came from 0, and by the end of 2018, they'd got to 2.25. And you can see as that process unfolded that this spread had fallen below 3%. And I'm not sure if many of you remember, but in the December quarter of 2018, equities fell almost 20%. And so that's pretty meaningful. So the key for us is monitoring this relationship. It can get there, it can change either by the market falling or the bond yield rising. And at the moment, the bond yield is rising as the outlook improves, and equities continue to rally as well. So we just monitor that relationship. As it starts to close down towards that 3% mark, we may see a little bit of increased volatility. And really the key for us will be monitoring that relationship, plus whether inflation, the charts we showed earlier, are starting to increase. If we go from a normal inflation expectation of 2 or 2.5% to something like 3 or 3.5, plus we can have lower yield here, it may cause the central banks to start changing their tact, because at the moment markets are priced for interest rates to stay very low for a very long time. And when you listen to the Reserve Bank governor or the governor of the US Fed talk, they just talk about keeping rates very low for a very long period of time. And that's fine, and it's good for now, and it's good for markets. But if that language starts to change, that's when we need to start thinking about what that means from a valuation point in markets and what it means for equities. So for now, we think there's a good return from being in equities versus bonds. We think the outlook for economic growth is strong and will continue to be supported by the reopening and the vaccine and all that stimulus. And we're just monitoring when perhaps that's gone too far and when the policy may change from central banks, which will see higher interest rates. That might be a time when we start changing our view. So in summary, We think the vaccine creates a path to herd immunity in the second half of this year, that the record government and central bank stimulus will continue despite the fact that we're past the worst of the recession. Economic growth will continue to accelerate with that stimulus and the demand increasing. I mean, US has got 2 million people a day getting a vaccine. That's 2 million people going back out into the economy with some gusto and confidence to re-enter. Equity valuations are looking stretched in absolute terms, in particular the US market. However, they're still attractive versus bonds and low interest rates. And so the key is really monitoring this relationship. And market leadership, we think, is shifting from growth to value and from the US to the rest of the world. And that's commenced, and we think that trend can persist. And our portfolios have been rebalanced, rotated, if you will, to capture that view. The potential for higher inflation this year is putting pressure on bond yields and interest rates, and we just need to keep an eye on that. That could be a late 21 or early 22 story in our view. And some risk to the outlook. We didn't really talk much about geopolitics because I've spent the last 3 years talking about it thanks to Donald Trump, and he's giving us a bit of a break on geopolitics for now. But something to watch carefully is US, China, and Taiwan. We think that the world, if data is the new oil, semiconductors are a really important part of that. And Taiwan is really at the epicenter of semiconductor manufacturing globally. The US and China are engaged in a war of supremacy as the global superpower, if you will. And they both need semiconductors as part of their technology supremacy. And so it's something definitely to keep an eye on. China's trying to exert its authority over the region and the South China Sea and Taiwan. And the US is, even under Biden, continuing to stand up to them. So it's definitely something we need to keep an eye on. I've got a policy mistake here, a quick withdrawal from stimulus. We think this is a low chance of occurring. Now, the reason is that if you look at the actions that governments and central banks took last year, they're very swift and very decisive in terms of the size and the speed at which they got the stimulus out following COVID. And we think that shows that they learnt their lesson from the GFC, where stimulus and support was slow to come, and then they were too quick to remove it, which really gave us that really slow and stalled recovery coming out of the GFC. So we think policymakers have learnt their lesson largely. But again, they'll be tested, we think, later this year as growth looks really strong and inflation is picking up. Maybe they'll feel like they can start to withdraw too soon. So it's just something we need to keep an eye out for. And inflation, which we've spoken about, perhaps it goes a little bit higher than what markets are anticipating, and that again could cause some issues. Got any? I think that's it, Steve. Unless you've got some questions.
We do, Tom. So again, thanks for going through that very informative and detailed presentation. So we do have a few questions here, and
fire away.
So if got a couple of questions around. We hear about different strains of the virus. UK strain, South African strain. Any thoughts on whether these new strains are going to be a meaningful threat to the vaccine rollout and a return to a more normal scenario?
It's a good question. And I think as we saw the UK strain, as it's been called, but there's a South African strain and various others, certainly something that I think we've had good reason to be concerned about. But the good news is that we've got 3 very good vaccines with high efficacy, which are being rolled out around the world, plus Russia and India's, if you like, the ones that we won't have approved here. But all of those vaccines, Pfizer, Moderna and AstraZeneca, have confirmed that they are effective against the new strains. Or the other thing that we think is encouraging, there's a great interview with the CEO, founder of Moderna, talking about the way in which they developed the vaccine. So they use what's called messenger RNA technology. They're using artificial intelligence to come up with the design of the antibody, if you will. And essentially, when the virus was first released by China, way back in January, actually, 2020, I've got to get my years right. It feels like a long time ago. Moderna actually put it into the supercomputer, if you will, and within 48 hours, they had come up with the vaccine. Now, So the one that is being used and rolled out today was actually created for in the lab in the test situation within 48 hours of them getting the virus itself. So it shows the power in which the science community and the healthcare communities come and using technology to combat these viruses. Obviously, then they had to go through a lengthy trials and approval process before it's able to be rolled out. But now we sort of understand what the virus is. What that's telling us is that even if it does mutate, a bit like the flu does every year, the technology is there, and the current vaccine is such that we should be able to adapt it to the new strains of virus, and so it should remain effective. And certainly that's the evidence that we're seeing to date. So, good question, but the data and the announcements so far suggest we shouldn't be worried about that.
Excellent. Few questions of similar sort of question around the repayment of government debt. So obviously, as one of your earlier slides show, with increased government stimulus support, there's always the question of how and when or what. Does it matter if that debt isn't repaid, or what's your sort of your views on the eventual repayment of that debt, or what's the market's view on government's ability to repay this debt over time?
It's a good question, and it's partly why we think the inflation story and the policy changes are heading down the higher inflation path. There are different ways to essentially pay down the debt. If you think about, if we think about debt as a gearing ratio or leverage ratio, you've all borrowed money before for your house or whatever, and you go to the bank and they give you 80% loan to valuation ratio. Well, let's look at the national balance sheet and say, well, what's the debt to GDP ratio of a country? In the US, the debt to GDP ratio is approaching 100% now. In Australia, we're just north of 50, and so there are different ways to pay it back. You can increase, either you physically save money, so we have austerity, so they shrink fiscal spending, save money, and physically pay back down the loans, or essentially use the low borrowing rates to inflate the value of the economy and thus reduce the debt to GDP ratio. And that's the path that we think governments are going down. It's much easier for them to do that because it involves free spending, which is good for winning votes. So essentially what they're doing is saying, well, we can borrow at 1% or 1.5% or 2% even, out over 10 or 30-year time horizons, and we can go and invest that money in the economy, which we believe can grow at 3 or 4 or 5% nominal, so the headline growth rate. So over time, that debt to GDP ratio will fall as a result of the growth created from the money spent. And so it's much easier for politicians to pay down debt by stealth, and that's really via inflation, and we think that's the path that's being adopted by policymakers the world over.
Mm-hmm. Fair enough. A couple of questions here around China and the trade war, which obviously Australia's been, dare say, to some level, a target of over the last few months. So. In terms of that coming into consideration for portfolio construction, or any views on?
Yeah, China, look, I think China versus the West, certainly we feel, look, we're being made a target in Australia and by the Chinese, and we're an obvious target because we're one of the few countries on earth that runs a surplus with them because of the amount of commodities we export. So certainly they're trying, and we're obviously smaller in size as an economy than Europe or the US, so we're a much easier target for the Chinese to make an example of. To date, it's affecting, I feel, for the smaller producers and farmers that it is affecting. At a national income level, it's not affecting us due to the iron ore price being so elevated. We're actually making more money out of iron ore than we've lost out of the other areas. But we think this remains so. There was, I guess, Donald Trump was a bit more vocal, and it was Twitter diplomacy, and he was a more attacking of China, whereas Biden's likely to assume a more traditional diplomatic approach. However, it's not going to be, or doesn't appear to be, any softer stance on China. His policies will be different, so less likely to focus on tariffs, which are really not the economically ineffective form of of dispute, if you will. They're not good for either side of the equation. Because of their sort of leaning, it's more likely to focus on they've already made comments around the human rights atrocities of the Uyghurs in the west of China. There's likely to be disputes around sovereignty. So Taiwan comes in and supporting Hong Kong and Taiwan and other Southeast Asian nations where China's trying to exert its authority. So I think holding up stability and strength of the region, and the US coming back into the region in a bigger way is likely to occur. So the disputes will continue, we think. They will just look and take a slightly different form. But it is definitely something that we need to take into consideration. But China's in disputes with the UK, with Europe, with many parts of the world in relation to goods and trade. And so it feels a little bit acute here, but we're not alone, put it that way.
One of the last updates we sent was regarding we moved some of the international exposure from unhedged to hedged. So just a couple of questions about what does that mean and why have we taken that view of the Australian dollar versus, say, the US dollar? Maybe just talk through that sort of portfolio construction at the moment.
So the first thing is that in bigger picture terms, thinking about where we are in the cycle, the US dollar tends to be a counter-cyclical currency. So when we have crises, everyone flocks to the safety of the dollar. And you saw that last year, where the US dollar appreciated significantly against all other currencies in a flight for safety. So the converse is true. When the global economy improves and strength comes back, people shift money out of the relative safe haven of the US dollar towards other, higher growth currencies, of which the Aussie dollar is one. We are what we describe more as a hard currency because we've got the commodities. So commodity prices are strong in a global growth environment. As we remember from many cycles, growth picks up, commodity prices pick up, and the Aussie dollar picks up. So we're in that reflationary environment where commodities are stronger, economic global growth is stronger, and that means US dollar weaker, Aussie dollar stronger. There are a few other considerations around it, but at the margin, that's the overarching trend, and we expect that to continue.
Now, just wrap up. There's a couple more questions just in response to one. No, we don't have any Bitcoin in the portfolio.
No Bitcoin.
But any sort of thoughts on whether you think that might become more of a mainstream asset class at any point in time, or is it still really a speculative world that
it's a really interesting we've tabled it at our investment committee internally, not because we want to invest in it, but because we think we need to develop a stronger policy around it. We've certainly been asking the managers as well whether they've got the ability to buy it and whether they would buy it, just because we need to be aware we may have, even if we didn't recommend it directly in the portfolios, we may inadvertently find that we have exposure to it, and we certainly need to be aware of that. So we are considering it. There is a lot of hype and speculation in the price, and something that we're watching. Bitcoin's the primary cryptocurrency, but there are 700 odd different ones as well, and we've been on cycles of crypto going up and down a lot, and they're all, I'm not quite sure which ones will survive and stay the journey. There are lots of considerations around it. There's a very limited supply of Bitcoin, and it's very volatile, so it's unlikely to form a meaningful amount of exchange or trade globally. At the moment, it is just a speculative asset. There's not a lot of goods and services that are actually settled in Bitcoin. So as a genuine form of meaningful form of exchange, we think it's got a long way to go. There's also issues around cybersecurity. If you've ever bought one and you've lost your code, and there's all these wonderful stories of, there's some guy in Wales trying to pay the local council to dig up his laptop from 10 years ago because he's got $250 million worth of Bitcoin sitting on a hard drive in the tip. There's a security issue as well, but it is institutionalizing a little bit. There are some bigger investment banks and investment businesses in the US particularly that are starting to say they own a little bit or are watching it. So it is evolving, but it's certainly, in our view, got a long way to go as a genuine form of exchange, and it's quite small in terms of the market cap still relative to most other asset classes. The other consideration, and is one of the big themes or trends in investing, is climate change and carbon neutrality. Munro Concentrated Global Growth, which we own, is, it's the single largest theme in that portfolio. It's 20% of the underlying assets are in wind farms, solar farms, stocks that will benefit from the greening of the economy. Bitcoin requires extortionate amount of investment in utility infrastructure and computing power, and it costs a lot of money. So it's really, really, really poor on the environmental scores. And so everyone wants to have a ESG or a greener portfolio, and we think Bitcoin is the antithesis of that at the moment. So it's unlikely also that central banks and governments in the world where they need more money and they've got all this debt to service are going to let an unregulated sort of global currency take over from their ability to control their currency reserves. And so I don't know, the jury's still out. We're not going to own it. We don't think it's secure, safe, or investable from a portfolio perspective. But it's meaningful enough out there in terms of size and movement of what it's doing to warrant us observing it, I guess.
A good answer. All right. Well,
sitting on the fence, Dave.
Exactly. It's always the best position to start for. Exactly.
But don't worry about us buying Bitcoin anytime.
Yeah.
So, yeah.
But look, again, through the questions, they were the themes. So hope if I didn't ask your exact question, or at least hopefully we asked a question that was related to what you asked about, rather than go through them all individually. So look. In terms of wrapping up, thank you for everyone for staying online. I can see by the numbers that we have kept everyone through the duration of the webinar. So hopefully that's a testament to your interest and for Tom's informative update. In terms of the relationship between Halcyon working with Drummond, all we can say, it's been a really excellent relationship for us, and you as the clients are really seeing the benefit of that. So as Tom will attest, we're in reasonably regular contact on the portfolios. It's certainly not a static process behind the scenes. There's a lot of communication. There's a lot of conversations that goes on, but rest assured that we're certainly working with an asset consultant that we know is really delivering great value for all of our clients. So to Tom, to you and the team there at Drummond, thanks very much. We look forward to a long relationship. Thank you to all the clients for taking the time to join us this afternoon. As we said, there will be a copy of this presentation uploaded to our website in the short-term post is finishing today. So again, Tom, thank you. To everyone, thank you, and we can wrap it up. Thanks very much.
Thanks everybody for joining us today.
Thanks,
See you next time.
Bye for now.
Thanks.